Blog
Good morning.
Talk Radio.
Good morning. It is Brian Dooley. Blog Talk Radio. And we're broadcasting from sunny Orange County, California. And those of you who've seen my blog at Brian Dooley CPA have learned that I pride myself in provocative tax news, tax stories. Today's story is just that type. It involves the famous singer Nat King Cole and his wife. Nat King Cole and his wife formed two foreign trusts in the Bahamas. The two foreign trusts formed two foreign corporations. One was known as PMSA, the other was Associates Arts. PMSA and Associate Arts were used to receive the income from Nat King Cole's foreign tours and to provide him with a deferred compensation. And back in the 1960s, deferred compensation was considered evil by the Internal Revenue Service. Foreign trusts in 1960 were not on the IRS radar. Hardly anybody had the skills to put them together. There's one man, one attorney, Harry Margolis. Harry Margolis was considered so effective in doing his foreign trusts that the IRS believed he was a Soviet spy in the United States to destroy our tax system. The best foreign structure is the theme that the Nat King Cole family used. While he lived during what I call the second wave last century, when we were the industrial society, he earned his wealth with third wave ideas. Third wave is the intangible, the cloud. In his case, it was music, copyrights. But now wealth is really third wave. Apple is about ready to be worth $1 trillion. It's all third wave. It's all intangible assets. Microsoft sells only intangible. So the question really is, can 1960 offshore trust planning really be today's state of the art in this third wave economy? Well, you bet. Unlike the 1960s, we now have a virtual tax haven created by Congress in 1996. It is a foreign country with no name or landmass. Seems really impossible. Well, the 1986 Tax Act allowed any trust located in the United States to elect to be a foreign trust for tax purposes. So if you are in California, you can have a trust with a California bank, with yourself as trustee. It is surely governed under the laws of California. But tax-wise, it is living in this imaginary country. Now, the state that I like the best is Nevada. It has the best trust laws. We'll get to that in some other Blog Talk episode, but it is a great state. The election is made in the trust agreement by including in the agreement what is known as a flee clause. Now, flee clause is a very popular, as some people are worried about the American currency. A flee clause requires the trust to flee the United States if certain events occur that place the trust asset at risks. That could be an invasion, it could be exchange control, is really whatever you feel will put your trust at risk. This one clause alone makes the trust residing in an imaginary country, a foreign country for tax law. The country, like I said, has no name. Now, the Nat King Cole case is a model of the best international planning structure. This case provides the blueprint for foreign source service income and licensing income of intangibles. And your intangible may not be a popular movie or a song. It may be your business's know-how, your business's customer list, your business's trademark, your business's branding, so many items that we do not even see as part of our business are really intangible. Just the software to control your inventory and that data is an intangible. Now, in my book, as you read about this famous entertainer, you'll see that his international tax planners got it all. His offshore estate planning was so solid that upon his death, the IRS did not even challenge his trust or his private annuity. So Nat King Cole pushed the tax planning to the limit. His format is today's state of the art, and I'm going to go back to that deferred compensation. Deferred compensation allowed him to take the money out of his foreign corporation at the time that he would be in a lower tax bracket. But the problem was he made so much money, it would be in his taxable estate. Sir Harry Margolis, his attorney, designed his deferred compensation to be like a pension, and the term that we use for tax law is a private annuity. So it was payable to him during his lifetime. Upon his death, it ceased to make any more payments. If he died early, the foreign corporation owned by the trust for his wife and children had a big upside. If he lived forever, he still got the money. Either way, the Cole family won. It's much like your IRA. This is retirement money or money for future growth. Now, his structure included two non-grantor foreign trusts, one for Nat and one for his wife, which owned the two foreign corporations. One corporation was for the tours overseas. The other was to own and license his copyrights. The two corporations were virtual companies that became major enterprises. By virtual companies, I mean they had no office, they had no employees, but they made a tax-free fortune. And when you look at compounding income, the difference between a 4% return, which is maybe a good after-tax rate, and an 8% return is not twice as much. It's 4 times as much over 20 or 30 years. Now, the Nat King Cole story took place a half a century ago. Nat King Cole was the first American to take advantage of multinational tax planning. As author and futurist Alvin Toffler explains in his book, Revolutionary Wealth, the production, sale, and distribution of intangible assets versus manufacturing of tangible assets, such as cars, know no national boundaries. And this is why it's so easy for you to convert your intangible income from U.S. source to foreign source. Nat King Cole produced and sold the intangible of music as services as an entertainer. He established multinational trust as the centerpiece of the structure. With this trust, his tax plan involved a few unique items. One, forming and using tax haven corporations, and not any tax haven corporation, one using the Dutch treaty to reduce the withholding tax on royalties, a technique still used today by Google, and as we saw on the news just the other week, the tax news, by Pepsi-Cola. He turned his copyright income to foreign source income, making it U.S. tax-free. Now, when you have a tax haven corporation, the tax laws has this nasty rule called subpart F income that makes the income taxable to the shareholders immediately. However, by designing his corporations in a very simple way, he avoided the subpart F rules. And as I mentioned, since the trust was an estate planning trust, all the assets were outside of his estate. Now, the IRS does not lay down quickly on this. They like to use the constructive receipt doctrine to put money back in the names of the U.S. client. The IRS surely used this attack against Nat King Cole. But the tax court who reviewed the case said Nat King Cole's paperwork and economics were perfect. Just like today, you need to have economic substance behind the transaction. I found surprisingly, Nat King Cole avoided the arm's length argument that the IRS uses with offshore structures with his deferred compensation. So the deferred compensation did 3 things. 1, it deferred his compensation so he's taxed sometime in the future. 2, prevented the IRS from using the arm's length pricing rules. And lastly, being paid out as a pension, it saved his family from paying death taxes. In the old days, the IRS considered this tax planning abusive. They may even consider it abusive today. But the tax court gave Nat King Cole top marks. He used 4 aggressive tax planning principles that were new in the 1950s. So here's the courage. This is 60 years later, 50 years later. Court cases have come down. We know the guidelines. The IRS will actually give one a private ruling on these points. Nat King Cole was brave enough to push the envelope. He's used deferred compensation, a big topic back in the 1950s. He used private annuities, another big topic. He used foreign trusts, another big topic, and treaty shopping. These were big topics and new topics. He was the first one on the block to be using all 3 of these with a multinational structure. So here's the story. In the old days, music was on a master hard media known as the master recording. In today's world, we would call this firmware for a computer. Now, music, if you're my age, was sold in a solid state. It was on a vinyl record. We used to call it vinyl, playing the vinyl as we heard on the radio. It's not like today where everything's intangible, MP3 file or iTunes. You actually went in the store, you paid sales tax on this tangible piece of property, and you walked out with it. Royalties were paid on each song sold, determined by the number of vinyl records. The tax accounting was easy, or the bookkeeping accounting was easy. Just like selling a magazine, you know how many you sold. During Nat King Cole time, few businesses provided services outside of America. An entertainer often incorporates himself, and we have a lot of that in California. This is known as a loan-out corporation. He's loaning himself out. This happens all the time now with movie stars, anybody in the entertainment industry, and even sports stars. Other professions have taken on this approach, accounting, laws, and in these fields, it's known as a personal service corporation. Same type of entity, just a different name. Now, before we get on to too much more of this, I want to kind of talk about one of the more important things to me is why does the government allow this? Why does the government allow a 1960 tax structure to still be used today? Now, we're going to listen to 2 presidents talking about the promise of tax reform. One is President Obama, last year in 2011. The other one is the conservative small business president, President Reagan. And we're going to see what they have to say.
And that's why this plan eliminates tax loopholes that primarily go to the wealthiest taxpayers and biggest corporations.
We're going to close the unproductive tax loopholes that have allowed some of the truly wealthy to avoid paying their fair share. In theory, some of those loopholes were understandable, but in practice, they sometimes made it possible for millionaires to pay nothing, while a bus driver was paying 10% of his salary, and that's crazy.
Middle-class families shouldn't pay higher taxes than millionaires and billionaires.
Do you think the millionaire ought to pay more in taxes than the bus driver, or less?
Warren Buffett's secretary shouldn't pay a higher tax rate than Warren Buffett.
Well, that sounds really good, doesn't it? But it's not true. It's political, blah, 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 talking. 1974, Congress and the president and the groups in D.C. made a big deal about closing the foreign trust loophole. By that time, Harry Margolis had won quite a few cases in tax courts with foreign trusts, private annuities. The IRS was being wiped off the map. With a big to-do, they passed a law. It looks like it's a real law, but it was completely ineffective. In 1996, once again, they decided, we made a mistake. We'll redo the law. This time we're really going to close it down. All they did was to make the law more popular. Around 2000, so I went back to Washington, D.C. to meet with the attorney in charge of IRS International. He was writing regulations on this new 1996 law. And we're in his office. His name is Bill. I said, Bill, why are you doing this? You know these regulations and this new law does no good. He says, I know, Brian. I said, well, why don't you go and get the law changed? And this is what he told me. Not verbatim, but close enough. He says, Brian, you know how hard that is? He says, I said, what do you mean? He says, well, first I have to fight everybody in Congress. Then I have to fight the people who have an ear of the president. And basically he was saying that it would never get through because the wealthy people are going to keep this loophole. And my question to you is, why are you not using it? See, it's not that you're going to pay tax at the same rate as your secretary or the bus driver. It's that you're not going to pay tax at all. That's the difference. Now, many people have gone to the IRS to get a private ruling, which is an IRS tax guarantee on foreign trusts. It's done through the Department of Treasury, and if you follow the rules, and the rules now are the clearest they've ever been. They are black and white. They're even better than they were in 1974. They are now a simple equation, which is covered in my book, International Taxation in America, available at Amazon, a little word from our sponsor. And by following these rules and getting a ruling, you're going to get asset protection if you use a trust in Nevada. You're going to get income tax deferral or elimination, depending upon where your heirs finally live in the future and what kind of tax laws we have. And you're going to get estate tax savings that are unbelievable. Now, let's get back to the Nat King Cole case, because more good things happened as he moved along. Nat King Cole's tours included himself, of course, his orchestra, his light technician, his makeup artist, his wardrobe, and his accountant. And when you go to a tour nowadays, it's the same as it was back then. The entertainment company is spending a fortune on these tours. So unlike just myself going to work outside the United States, Nat King Cole's tours had a lot going on. And since that time, the laws have even improved more for this type of tax planning. And some cases came down on other entertainers in the 1940s. And the way the law was put together was in a loan-out corporation, which is used all the time today. So let's say the loan-out corporation is called Brian Dooley CPA. That's the name of the loan-out corporation. But I want my corporation to pay the tax, not myself. When I send you the engagement letter, I state you're hiring Brian Dooley CPA Incorporated versus Brian Dooley. That is enough to allow the income to be earned by the corporation. Same with a foreign corporation. If the name of the corporation was Brian Dooley Limited Grand Cayman, and the engagement letter comes out from that corporation, the income is earned by that corporation. And if Brian Dooley would take his laptop and fly down to Grand Cayman, sit on the beach and do your tax return, that income is foreign source. You can pay me in Bank America here in Newport Beach, it's still foreign source. The situs of the income, the location of the income is where my butt is at the time I'm doing the work. If I did the work in Newport Beach, it's U.S. source. Now, the fascinating part is computers, smart computers that are using not just information, but are using logic to come up with new products. If that computer is residing, sitting outside of the United States, the income it earns for you is foreign source. If it's inside the United States, it's domestic source. And what's unique about American international tax law, place of payment is completely ignored. You can use Visa, MasterCard. You can have all U.S. customers. It makes no difference. So this is the end of this episode. You can always get to my blog and get more information. Of course, I have my book, and I look forward to talking to you all next time, and have a great day.